control.
All right, let's get back to those breaking headlines coming out of Jackson Hole, Wyoming. You're looking at a live shot of the head of the U.S. Federal Reserve, Jay Powell, speaking right now, and the stock market extending gains after Powell said, quote, "The time has come for the U.S. Central Bank to start cutting interest rates." His comments cementing expectations for an interest rate cut at the next Fed meeting in September. Powell saying the cooling of the American labor market is, quote, "unmistakable." And he added, "We do not seek or welcome further cooling in labor market conditions." Of course, there was always going to be that balancing act between the fight against inflation, but also the worries on the jobs front. Powell also said his confidence has grown that inflation is on a, quote, "sustainable path back to the Fed's goal of 2%. Now, as I mentioned, that has investors putting more money to work in the stock market at a time when we were starting to get back closer to the all-time highs for the S&P 500. Now, our next guest is pretty bullish on stocks, saying the tail end of the year could be a continuation of the bull market that got started in 2022. He adds that the back half of election years tends to be overwhelmingly positive. With more than 4 decades of experience as an investor and as the founder of a firm that manages more than $270 billion U.S. in assets, Ken Fisher is the founder and executive chair and co-chief investment officer at Fisher Investments, and he joins us now. Ken, it's great to have you back with us. Appreciate your time.
Thanks for having me back on, John. You interviewed me the last time I was on BNN Bloomberg, but it was in your evening show.
Yeah, there you go. And obviously, we have a new piece of information to work with this morning, and that is this what feels like a confirmation from the head of the Fed that after this interest rate hiking cycle, that a pivot is on the way in September. What's your reaction?
So, as I've said in my monthly Globe and Mail columns, I really don't think any of this is important the way most people think it is. Central bankers be crazy. It's a real simple point. They never know what they're going to do. Jay Powell has a long history of not knowing what he's going to do. They're very reactive. My basic policy whenever they speak is to keep my eyes open and my ears closed. And the fact remains that if you just take, and I said this in the Globe and Mail, the month before they started hiking rates, every month but one, 5 in a row by 0.75% each time, Jay Powell openly said, "We are not even considering 0.75% moves." Literally a quote. The next month they do it. He doesn't know what he's going to do. They never know what they're going to do. Don't worry about it. Paying attention to what central banks do is a little bit like trying to guess who's going to win and lose in musical chairs when the music never really stops.
And yet we like to do it. It's a curiosity for our audience, and it keeps us in business and television, just as politics and the gamesmanship around who might win an election keeps a lot of cable companies on the air as well. That's the other dynamic at play right now, is a lot of people are trying to figure out what happens to the stock market in an election year. That's something that you've been thinking a lot about as well recently. What's your current thinking about how that story should influence the stock market story from here on out?
So, John, first, you kind of shorted me there. You know, it's not 4 decades of experience. I've been doing this stuff for over half a century. I'm just older than I look. And the fact is, election years in America have a real consistent history where when you have, first, they're positive in U.S. market history, 83% of history since accurate daily data began in 1925, with 11+% average annual returns. But when the first half of the year has been positive, as was the case this year, that's happened 9 times. The back half of the year has been positive 8 out of the 9 times. The last time it didn't happen, the one time it didn't happen was 1948 during a prior inflationary boom. And the fact is, we get falling uncertainty in a presidential election. We start off most years when we have a presidential election having one or maybe both candidates being uncertain as to who they are, and we go through that primary process, and there's a lot of extreme statements made and craziness said, and that creates uncertainty. And then finally you get two nominees, and then they lay out platforms, and then they lay out what they're going to do, and then you get the campaign. And as you move toward November, you get falling uncertainty. Stocks like falling uncertainty. They don't like rising uncertainty. This year, we started off with a fair amount of certainty because pretty much everyone knew it was going to be Trump versus Biden. And yet, when we got to the middle of the year and Biden dropped out, you get increased uncertainty. That falls heavily as we move into the year, now having two candidates, campaigning beginning actively in September that will make the campaigning so far look moderate. And we'll get increased certainty regardless of who wins as we move to November. People like that.
All right. Ken, the other dynamic beyond interest rates or election years has been sector stories. And in a year where everybody started off talking about tech and AI, then when we had a hiccup in the market, there was increasing talk about rotating into other parts of the market. As an investor, where do you feel most confident right now when it comes to different industries and sectors or stocks?
Let me make this really simple, John. It's so simple and right in front of everyone's face, they can't quite see it. Not perfectly, but almost perfectly, including today. On days when the market is up, tech goes up more than the market. On days when the market is down, tech goes down more than the market. You tell me where you think the market will go, and if you're right, I'll tell you whether tech will lead or lag. The fact is there is nothing about this year that has broken that trend whatsoever. When we had the summer drop in mid-July into early August, tech lagged. That made people think, oh, this is over, we're moving into rotation. As the market came back, tech led almost every single day. Tech up in a up market, and more so than the market. Tech down in a down day market, more so than the market. Since I'm bullish and since I believe the back of the year will be positive for the market, I believe tech will lead. Therefore, by definition, I believe the most defensive parts of the market, like consumer staples in particular, will be tending to lag.
Now, before I let you go, you've heard it. It's not coming from me. It's everybody out there on valuations in tech. There are certain names that people think are at lofty levels. And then all of a sudden, we start having a fresh conversation around whether we're in a bubble. I think the most common question is whether we're in an AI bubble. After all your years in the markets, what is your view on that?
So let me make 2 points about this. First, and I've done a lot of work on this, I've written a lot about this, valuations are never predictive in the short term in the stock market. They just aren't. In 1 to 3 year periods, valuations are never predictive. They just aren't. There's a lot of data. You can measure that perfectly. Secondarily, a basic rule in life is when people start calling something a bubble, it's probably not. Most bubbles surprise us. In history, the greatest bubbles surprised us hugely. Things labeled bubbles mean there's already fear in them. And if there's fear in them, they aren't a bubble. Bubbles tend to be where we all are caught short by not having fear about something that gets too carried away. Interestingly, next week, as NVIDIA announces earnings, there'll be a lot of hoopla about that one way or the other, depending on how they come in relative to expectations. And that's a little bit like when we were talking earlier about getting excited about either what Jay Powell says at Jackson Hole, which most people should just ignore, or what the Fed does in September, whether it's a little more or a little less. It's all noise.
All right.